Shares in Asia Pacific are tumbling after the S&P 500 fell overnight and closed in bear market territory, which means that stocks on average fell at least 20% off their highs. And yesterday, the index fell as much as 4% in the US, bringing its losses since January to more than 21%. Today, the Nikkei and the Shanghai Composite are all painted red as investors react to rising recession risks and the possibility of more aggressive interest rate hikes by the US Federal Reserve. According to the Wall Street Journal, Fed policymakers are now contemplating a 75 basis points rate increase later this week. That's bigger than the 50 basis points hike that was expected. For more on this now, let's go to Stephen Innes, who is SPI Asset Management Managing Partner in Bangkok. Many thanks for being with us this morning. First of all, what's happening really? What is this telling us? I mean, where are markets headed? Are they headed for short-term recessions or rather a longer-term stagflation where growth as well is going to be slower?
Well, it really depends on the course of inflation. I think right now the focus remains on Fed hike expectations and what those hikes are going to do, a possible hard landing. And that's really where the recession narrative is evolving from. Market now sees about 200 basis points of tightening in the next three meetings, including the possibility of 75 basis point hike, according to that Wall Street Journal article you mentioned earlier. But I still think the widespread consensus here is equities haven't bottomed. There are, thoughts of these second waves of earnings slashes coming out, lower consumer demand because those higher rates and probably expected slowing global data. These will all dot the horizon negatively. And, but let's face it now, the market's coming to terms with inflation and we're probably moving in the right direction. And that's not such a bad thing as people actually prepare for the worst.
So you say we haven't seen a bottom yet in equities. And what about bonds? Because we're seeing all asset classes falling, really, and currencies as well, and cryptos as well. What would happen in the event that the Fed were to really raise rates by 75 basis points in one go? What would be the reaction of markets?
Yeah, it's interesting because now that it's sort of the cat's out of the proverbial bag here, that there's a good chance that 75 hits this Wednesday or Thursday. The fact that they've telegraphed this, markets can brace, and that's not a bad thing. But also the thought here of front loading the next three rate hikes possibly could effectively slow inflation, and that actually could start to slow the pace of rate hikes into Q4. But look, the real uncertainty here is how far and how fast the Feds have to go. And that's the big problem that markets are trying to figure out right now. If it ends up being quarters, not months, I think the market is going to be in a world inflationary hurt. And that's a real big problem that markets will be facing, just that ultimate uncertainty when inflation peaks.
Right, interesting. Stephen, just one question on crypto, really, because there's been a real bloodbath in cryptocurrencies that were falling some 18% below $21,000 at some point. I mean, and I guess a lot of investors are now wondering, is this an entry point, or rather, should they wait further? What's your feeling now?
Well, it's shocking, really. I mean, the bear market blues have basically engulfed every asset class. But I think miners have been selling down a lot of their existing coins, and that's probably created the move towards the 20,000 mark, as it did break the 30,000 mark in May. I think there's also regulatory oversight that's hitting at just an absolute horrible time. We've also got the Fed turning off the taps, and it's going to end up liquidity will end up looking like the Mojave Desert. There'll be nothing out there for a long time. Now, none of this is to suggest that we're going to see the return of tulip mania, where cryptos just melt away. I think the medium term looks actually quite good here when you bring regulatory oversight into the scrim. So I think there's a favorable lean here. We're seeing a lot of positions exit, and I think as we come to terms with this regulatory oversight, I think it'll induce more buyers back into the fray.
Stephen Innes, many thanks for this update.
Thank you.